Okay, this lecture is called Capital Investment Analysis. And companies that make large investments, and most companies do in some way or form, really have to take a careful look at a proposal, because if you miscalculate and you invest in something that doesn't generate a sufficient return, you're going to lose a lot of money. And you may be borrowing money, issuing stock. I mean, think about when a big airline has to project what future worldwide demand is and base their airplane acquisitions on this. They may be buying a dozen 747s and 20 787s and Airbus planes, and we're talking several $1 billion. When Intel decides to build a chip factory, that's $2-3 billion per factory. These are significant investments. Okay, and so we have several techniques we can use to analyze long-term investments. Okay, and of course we're going to take a simplified look at them. And at the end of the lecture, we'll talk about additional considerations, which in the real world, of course, we have to take into account. But we'll try to keep it simple in the early stages here. Now, we have a total of 4 methods that we're going to look at in this chapter. The first 2 methods ignore the time value of money. Now, for those of you who have not had exposure to time value, I have a separate recording called The Time Value of Money, and I would encourage you to take the time to review that, because we're going to use time value calculations in this chapter. And I'm going to make reference to present value tables, and the assumption is you're familiar with that. So if necessary, go back and watch that time value lecture. Now, these first 2 methods ignore the time value of money, and because of that, they're not really as good a technique. We call them preliminary screening or testing methods to see, okay, does this proposal have a fighting chance? Should we take a closer look at it? If it can't pass these first 2 tests, chances are we're not going to delve any deeper. So the first 2 methods we're going to look at is called the accounting rate of return, and this goes by a variety of names. It could be the average rate of return, annual rate of return, simple rate of return. Okay, and so we're going to use whatever your textbook uses. That's the term we're going to use. And then the second method we're going to use is called the cash payback method. And again, both methods ignore time value, and they're kind of our first test. Can this proposal pass the first hurdle? If so, we're going to use other evaluation techniques that use the time value of money, and these are better techniques to evaluate the quality of a proposal. Okay. The accounting rate of return, average rate of return, whatever you want to call it. Okay, we take a quick look, and what we do is we take income, which is an accrual basis term, right? And notice the formula we're going to use. Estimated average annual income. Okay, and when we say estimated average annual income, this is from the investment only. If we make this investment, what income would this generate each year? And we're going to divide it by the average cost of the investment. That's the formula we're going to use for this method. Now, the average investment, and by the way, different textbooks will use different formulas. That has to be recognized. Average investment, we're simply going to take the initial cost of the investment. We're going to add residual value, divide it by 2. Okay? For simplicity's sake, we're going to assume salvage value is 0, but I just want to make a brief comment on this concept. I have a little graph here. It's not the best graph we've ever seen, but what it does is look at the data in this example. The cost of the investment is $100,000. That would be kind of the top of the graph there. And 2 different scenarios to illustrate this point about what is the average cost of the investment. If the salvage value is $20,000, okay, the bottom of the graph would be 0. That second line is 20,000. Notice that I draw a straight line from the beginning of the investment cost at 100,000 to the end of its useful life, where we'll recover 20,000, and then I bisect the horizontal axis to the halfway point at the midway point of the asset's life. You can see that the average cost of the investment would be higher than if we use a salvage value of 0. Okay? 100,000 at the top, 0 at the very bottom. You can see where that intersection is. The average cost of the investment will be lower when salvage value is 0 versus salvage value of 20,000. Just wanted to point that out briefly. It's not really a big issue, because in our examples, we're going to assume that salvage value or residual value is 0. And that'll make life a little bit easier for us. Okay, now in our example, the cost is $250. Useful life is estimated to be 5 years, salvage value 0. The expected income over the life of this investment, we're going to generate a total of $300,000. Okay, so the average annual income each year, 300 divided by 5, is $60,000 per year. The average investment value, and then again, go back to your formula from the previous slide, 250 divided by 2, on average, half of its life it'll be worth more than 125. The second half of its life will be worth less than 125. That's where that average number comes in. Average rate of return on this investment, $60,000 per year. On an average investment value of 125, 48% return. Okay, now again, this is a preliminary screening mechanism. And again, there are several different formulas for this particular method. Okay? Different textbooks use different formulas. Use whatever your book is using. Okay? So this uses accrual basis income, operating income, net income. Again, it'll depend on the textbook you're using. The second method is called the cash payback method. Now, this is a slightly better method because now we're using cash flows. We're still ignoring the time value of money, but we're going to use cash flows instead of accounting income. Okay? Now, the definition of cash flows for these purposes is a simple one. Operating income plus depreciation expense. Remember, think back to when we record depreciation, we debit depreciation expense, but we credit accumulated depreciation. We do not credit cash. Depreciation expense is a non-cash expense. So to determine cash flows, and cash flows, by the way, is think of the revenue coming in, the money coming in, that's an inflow. The cost or expenses is an outflow. We add back depreciation expense because it's an expense that does not require a payment of cash. So operating income plus depreciation expense gives us cash flows. Now, two different scenarios. Some investments we believe will generate an equal amount of cash flows each year. And some investments will generate different cash flows each year, depending upon when we bought it in the first year, and maybe we expect the economy to improve, and we're going to use that asset more in future years. And so sometimes the numbers, the cash flows each year will be different. So two different ways we can calculate the cash payback period. Okay? The payback period is the length of time that it'll take for us to recover the initial cost of the investment from cash flows, ignoring time value. If the net annual cash inflows is the same each year, we can take a shortcut and we use this formula. The cash payback period in years will be the cost of the investment as your numerator, annual net cash flows. Again, we're assuming it's the same each year in this example. Okay? And so, for example, if we have a cost of an investment that's $150,000, 10-year life, will generate annual net cash flows of $30,000, then 150 divided by 30 will recover our investment in 5 years. Okay? Now, management may have a policy, and we just made up some numbers, that any investment should be recovered within a 6-year period, and it should certainly be recovered before the end of the useful life. That's an absolute deadline. If you can't recover your investment by the end of the useful life, you're not going to recover the investment. Okay? So, 150 divided by 30, 5-year useful life. Since it's less than 6 years, it passes that initial test. And now we'll say, all right, you know what? It met the cash payback period test. Let's take a closer look at it, and let's use a more involved technique. And so now we're going to look at the techniques that use the time value of money. And again, we have another lecture recorded on time value. You may want to review that to get more out of this particular lecture. Now, if the cash payback method has unequal cash flows, okay, and in this example, okay, notice in year 1 I expect $60,000 cash flow. In year 2, $80,000. Year 3, $105, $155, $190, etc. So the way that we determine when we'll recover that initial investment using the cash payback period is we add up the cash flows each year and find out at what point does it equal the cost of the investment. So look at the second column on the right. End of the first year, we have $60,000 in cash flows. End of year 2, 60 plus 80 is 140. It's kind of like accumulated depreciation conceptually. End of year 3, I add 60 plus 80 plus 105. There's 245. End of year 4, I add up the first 4 years' cash flows, 400,000. Now in this example, if our investment cost was 400,000, then the cash flows are recovered in 4 years. More often than not, it's not going to land right on the money. Okay, so at the end, somewhere between, let's just say the cost was 450,000. Just changing the example here. That would mean that somewhere between year 4 and 5, I would recover the cost of the investment. So what I could do is, for example, in year 5, I have $100,000 of cash flows. If I assume that the cash flows are received equally throughout the year, I could divide 100,000 by 12 months, and that would give me, I'm just going to say, 8,000 and change of cash flow each month. And then how many months at $8,300 of cash flow each month would I need to get to the 450 investment cost? And it would take about, I'm going to say, 6 to 7 months. So it would be 4 years and say 7 months would be my cash payback period. Okay? So more often than not, you're not going to land right on the money like we did here, right at exactly at the 4-year point. It'll somewhere between 4.5 years, 4 years, 6 months, 7 months, whatever it may be. Okay? So take a look at that, and you'll see that it's pretty straightforward concept. All right, now the next 2 methods we're going to look at take time value of money into account. Now, the concept of time value means that if I'm going to receive, say, $10,000 3 years from now, okay, that money is actually not worth $10,000 today. It's worth less. Because if I were to put $10,000 in the bank today and I can earn interest, I'll have more than $10,000 3 years from now. So $10,000 to be received 3 years from now is worth less today. Its present value, today is the present, its present value is less. How much would it be worth today? That would depend on what interest rate we assume we would have earned. Okay? And again, review the time value lecture. Now, if I assume I could earn 5% interest, then I would take $10,000 and I would discount it back 3 years or 3 periods using 5% interest, and I would find out that the value of that $10,000 3 years from now, today it's only worth maybe $9,000. But you can figure out the exact amount discounting it back 3 periods. Okay? And that's the whole concept with time value. The further out you project cash flows, the less those future numbers are worth today, the further we go out. Okay, and we're going to see examples of how we factor this into our decision-making process. Okay? The net present value method. First, identify your cash inflows. Okay, so for example, I'm just making up numbers here. If this is a 5-year investment, okay, and each year, I think the cash flows would be $50,000. Okay, what is the value right here at the present moment? What is the present value of these cash flows? PV of cash flows, present value of cash flows. And what I would do is I'd say, all right, I need to figure out $50,000 to be received 1 year from now. And if we were to say take 10%, I would discount it back 1 period at 10%, and it would be worth, I'm just going to say, $49,000 and change. And then this payment, what would that be worth today? Because if I were to put a certain dollar amount in the bank today, I could earn year interest, 10% interest for 2 years. So that would be less than this number. That might be, I don't know, 48 and change. Probably less than that. This one, I have 3 years to bring it back, to discount it back 3 years, bring this payment back 4 years, and bring this payment back 5 years. So the further out we go on a timeline, the lower the present value of each of these future payments. Because if I were to put a certain amount of money in the bank today, the more time I have to earn interest, the more it would grow. So discounting back using present value reverses the effect of interest. And we're going to see an example of that. Calculate the present value of all future inflows, revenues, for example. Calculate the present value of all future expenses related to this investment. Inflows minus outflows gives you your net cash flows. Subtract the present value of the outflows from the inflows, and you have your net cash flows. Net always means after you've subtracted something. Okay, and the general rule of thumb is this. If the net present value is positive, then it's a good investment because that number tells us that the actual rate of return on this investment was higher than our minimum required rate of return. And I would give you that number. Okay? Each company says we need to at least recover this amount. Okay? If our cost of borrowing is 6%, this investment has to beat that, or else what are we doing this for? Okay? If the net present value of an investment is 0, then the rate of return on this investment is the same as your minimum required rate of return. And if the net present value is a negative number, then we're not even achieving our minimum desired rate of return. Don't invest. Okay, let's take a look at this example. Cost of new equipment, $200,000. Expected useful life, 5 years. Minimum desired rate of return, or minimum required rate of return, same thing, 10%. Here are the cash flows. Now notice in this example, they're different each year. Year 1, 70, year 2, 60, year 3, 50, year 4, 40, year 5, 40,000 as well. Total cash flows, if you add those up, are 260. But that does not include the time value of money. Okay, let's look at this table. Now, because my cash flows each year are not the same, this is not an annuity. An annuity would be when payments are the same each year, for example, for several years. They're not the same, so I cannot use an annuity calculation. Okay? The present value ordinary annuity tables are a shortcut, but I can't use that here, so I would have to go to the present value of one table. And again, that's in that other lecture. And what I would do is I would find out that assuming I can earn 10%, then $1 today, or $1 1 year from now, is only worth 90.9 cents, 0.909. $1 2 years out is only worth 0.826 cents. So what I do is I take each year's annual net cash flows, and I'm going to discount it back to its present value. So I'm just going to change these numbers on the board. We'll see the final thing on a slide here. We have what? 70, 60, 50, 40, and 40. And I got to bring these back to their present value. The way I do that is I go to my table, the 10% column, and rows 1, 2, 3, 4, and 5, I multiply, and the present value of these cash flows is 63, 630, 49, 560, etc. I add up all 5 years of discounted cash flows. It comes to 202,900. And I compare that to the cost of the investment. The cost of the investment was $200,000, so I subtract present value of all my cash flows, subtract the cost of the investment, and that gives me the net present value. That's your formula right there. And notice it's a positive number. So I used 10%, which was my minimum required rate of return, and since the number, the net present value is positive, although I don't know what my actual rate of return is on this investment, what I know is that it is higher. It exceeded my minimum required rate of return because the end result was positive. And so it meets the test that we beat the minimum required rate of return. So that's good. That's a good thing. And here's the exact calculation, bringing them back to their present value. It's kind of what I did on the board here. Okay? And notice they put the cost of the investment up front. I add up my cash flows and then I subtract cost of the investment. And notice it's in brackets. It's a negative number. But we end up with $2,900 positive net present value. Okay? So that means it looks like a good investment. Okay? So take as much time as you need. Hit pause, look at it, think about it, go back. Okay, but get an understanding of this. These methods are actually used. These are valuable techniques for companies. Of course, it's not factoring in several other things, which we'll talk about at the end of this lecture, which in real life you have to. But the concept is a sound one. Okay, and here's our conclusion. Because the net present value of 29 is positive, then we're beating our minimum rate of return, and we would say, all right, looks pretty good. Now, related to the net present value is something called the present value index, also called the profitability index. And look what we're doing. We're taking the total present value of cash flows, which in our example was $202,900, dividing it by the cost of the investment, $200, and that says dollar for dollar, each dollar invested generates discounted cash flows of $1.01. It's a positive number. This is a useful tool when we're evaluating several different possible investments, and they may cost different amounts and generate different cash flows. Dollar for dollar, we can then compare them side by side. Okay, so in this example, we have three proposals. On the top is the present value of the net cash flows, that's inflows minus outflows, divided by the cost of the investment. Okay? And there's the present value index towards the bottom. We can see that dollar for dollar, proposal B is the best investment. Okay? And so it takes kind of the size difference out of the equation. This is why percentages are useful to us. Because when you're comparing two different size companies, dollar for dollar, we can see which one is performing better. Okay. Net present value has some advantages. It uses cash flows, which is always desirable in business. It uses the time value of money. And using the present value index, we can compare multiple proposals. A couple of disadvantages. It's a little more complicated. And the big issue is how safe an assumption is using one interest rate for each year. And that, of course, in more complex analyses, they take that into account, where they may use different percentages based on different years. Okay, and so using the same interest rate of return for a long period of time, the longer you go out into the future, the more difficult it is to predict all the things that could happen to your business, the economy, the environment, competition, technology, etc. So the further out you go, the murkier it gets into the future. And so that's a kind of an issue that simply has to be recognized. The last method we're going to look at is called the internal rate of return. Okay? It's got a mind of its own here. The internal rate of return finds the actual rate of return. So you know the net present value, it's either positive or zero or negative, but it doesn't tell us what the actual rate of return is. This technique can tell us the actual rate of return. However, we do have to make an assumption with this method for simplicity's sake, and I'll point that out momentarily. The internal rate of return, IRR, internal rate of return is the rate that will cause the present value of the proposed capital investment to be the same as our cash flows. And this is the formula you're going to use. And notice, this is the same exact formula as the cash payback method that we saw earlier. However, the cash payback method ignores time value. This method does not ignore time value. It takes it into account. So when we take the cost of investment and we divide it by the annual net cash flows, that number, which previously in the cash payback method was the number of years it would take to recover our investment, this number here is our internal rate of return factor, which we're then going to find in the present value annuity table. Okay, so we go to the present value annuity table. Using the useful life of this investment, that's the row, that's the number of time periods. Okay, and so we have the factor from our formula. We use the useful life as the row, and we're going to go across that table until we get close to our internal rate of return factor. Now, that number is going to fall underneath one of the columns, which are interest rates. Okay? So we find we're usually going to end up being between two columns. You're never going to be right on the money. And so you're going to pick the column that you're closest to. And there, again, there are more advanced techniques to come up with an exact rate of return that's in between, say, 10 and 11%, but we're not going to look at that. And you go up, and you find out, this is my actual rate of return on the investment. I'll compare that rate of return on this investment to my minimum required rate of return to see if I like this investment. Okay? The internal rate of return exceeds our required rate of return, it's a good thing. Pretty common sense. Okay, let's take a look at an example. Assume that management is considering a proposal to acquire equipment costing $97,360. The equipment is expected to provide equal annual net cash flows of $20,000 for 7 years. Okay, so 7 years is my useful life. So I'm going to divide $97,360 by 20,000. And my internal rate of return factor is 4.868. Okay, so that's the number we're going to use. And we're going to go to the present value ordinary annuity table. This asset is expected to have a life of 7 years. So we're going to go down to the period 7 row. Okay, so the 7th row. Now, the factor that we were looking for, I'm going to have to go back previously. Actually, let's take a quick look. It was what, 4.868. Okay, and lo and behold, wouldn't you know it, it's the beauty of a classroom and a textbook. We landed right smack on the money. So the 7th row, there's my 4.868. I go up, and the actual internal rate of return of this investment is 10%. Now, in reality, you're not going to fall right smack on a number. You're going to be in between, say, 10 and 12% or 10 and 11%. And then there are formulas you can use to say, well, the actual rate of return was 10.57. We're not going to look at that particular formula. So, there it is. Once you find the factor, useful life is the row, you go up, you find 10% is your rate of return. Now, a logical question would be, well, what happens if each year you don't have the same actual cash flows? And the answer to that question is, it then becomes a more cumbersome set of calculations. And the good news for you is, we're not going there. Okay? So yes, it's a very real scenario. There are ways in which we can do it. It's simply time-consuming, cumbersome, and it's kind of a hit-or-miss trial-and-error basis. So we're going to skip that scenario. We're going to assume for the internal rate of return method that annual net cash flows each year are the same. Then we can use our formula, and we can isolate the actual return that this investment proposal would generate. We would compare it to our minimum required rate of return. What do we require out of this thing in order to invest? If it exceeds the minimum required return, we like it. Okay, some advantages. It takes cash flows into account. It takes time value into account. Disadvantages, it has complex computations, especially if it's not an annuity. Okay? And notice it says, assumes cash received from proposal can be reinvested at the same rate of return. And we talked about that earlier. That's not always a safe assumption. Now, in more advanced techniques, you can use multiple interest rates to address that issue. Okay, we cannot ignore these scenarios. Well, if you make money, guess what? You're going to have to pay tax on it. So we have to factor in tax implications, which means we need to know what our tax rates are, federal and state, as this year as well as future years. So you can see it gets a little bit more complicated. What happens if I'm comparing an investment with a 6-year life to an 8-year life? How do I compare 8 and 6? You can do it. You make certain assumptions, but it complicates the matter. Leasing versus purchasing. Uncertainty. Again, the further you go out in time, the more uncertainty exists because things can change. All right? Changes in price levels, don't have to worry about that. And then qualitative factors. I'm comparing two different costs of proposals, but this one might make a better product, provide a better service, have less pollution, Okay, and so what other qualitative factors? Maybe one machine requires less workers, which means I'd have to lay off some people, might affect employee morale. So you always have to factor in what other issues, not just the dollars and cents, but we call the qualitative factors before you make a final decision. And that's it.